All right, we're at the top of the hour here. Still got some people filtering in, so we'll give it another 30 seconds or so. For those that are joining today, we're going to work through something that's very specific for plastics procurement folks. When you get a supplier nomination letter for price increase, and we're going to walk through exactly how prepared buyers respond versus how, a lot of other buyers do. So it should be a good one today. Brian, how we doing on participants? Looks like we've got a good number still coming in here.
Yep. People still popping in right now. So,
Perfect. Perfect. Okay. Well, let's we always aim to be respectful of everybody's time here, so let's go ahead and get started. Welcome everyone. I am Michael Workman, the commercial director here at ResinSmart by RTI. With me today, I had the privilege to be joined by Brian Balboa. He leads our market intelligence work in the market, and Brian's going to be handling a lot of our data analytical segments today. I'll be covering some of the commercial and procurement strategic, items that we cover. Between the two of us and the team here at Resin Smart by RTI, and we cover nine resin categories, thousands of buyer situations over the years, and we've got a lot of ground to cover today. Where I want to start is what's on the screen here. If you read that letter, it's not a real company. If we've got some Better Off Ted fans out there, you'll recognize that company, but it's not a real one. It's a real letter though, right? You've seen some version of this, stated dollar amount per pound, an effective date that's maybe 30 days out if you're lucky, request to confirm acceptance in a few weeks, and a paragraph that really doesn't tell you a whole lot, right? The market is up, energy, cites those very generic things. And here's a question I want you to sit with before we get into the framework and the data. What do you actually do as the buyer when that letter hits your inbox? So the outline on the side of the screen here, it's the menu of typical options that buyers think through: pushback verbally, request justification, um, accept and pass through, right? That's certainly a strategy. Uh, Validate with independent data, though, is the one I want to focus on, and I would assert that it's the only one that creates real leverage at the negotiation table. Everything else is a reaction, and today we're going to talk about what that difference looks like in practice. So before we go too far, I want to make this quantitative because it's easy when we're talking plastics procurement for things to get abstract, and we don't want that to happen today. The math on the screen is pretty straightforward. 8 cents a pound difference for somebody buying 5 million pounds annually, it's $400,000 gone, right? Not stolen dramatically, but this is the type of thing that can be quietly absorbed quarter after quarter because a negotiation went sideways before it really even had a chance to get started. And I use 8 cents a pound deliberately. It's not a wild swing. It's the kind of gap that can exist between buyers that are similar volumes, and between somebody that knows what what they should be paying versus somebody that doesn't. It's not a reporting issue. This is a procurement process issue, and it's a P&L issue, right? It's margin protection. And with that, I want to kind of pivot to negotiation outcomes. Those are often set before you walk into the room. And there's typically four ways we talk about that explain the majority of ways that manifests itself. And the frustrating thing can be that none of them really requires a bad actor. Does it require, what I mean by that is a supplier relationship that's turned south, or somebody on the buy side that maybe wasn't doing their job. It's really failures of information. Brian's going to take the first two here, timing and trust, and I'm going to cover the next two, precision and access. Brian, I would love to have you take it from here.
yes, sir. So what I want to do first is actually we have a poll that.
Oh, you're right. I
So
always have a bad habit of blowing through that.
yeah, so I really want to get this poll done first because it's four questions which we're going to talk about right now. When you receive a supplier price increase letter, what's your first move? Again, the choices are: look, are you going to accept and pass through that increase? Are you going to push back verbally? Are you going to request justification? Or are you going to validate using independent data? So definitely some things we can talk about. And wow, this poll is already lining up. I mean, the top answers right now so far, Michael, are validate using independent data and request justification. Wow, I don't want to. I could look at
Perfect.
today. I could look at
We
all.
got we got a lot of buyers that have got a good head start, right?
Yeah,
And
yeah.
we're
So let's jump into it. Really, number one, the timing problem. Look, the first failure mode is lagging index dependence. Most buyers who are trying to do this right, who are not just guessing, but using published indices. Um, and having published indices, look, they have a fundamental structural problem. They reflect market movement about 30 to 60 days after the fact. And, we could look at the timeline on that slide that you're showing, look, usually it's month zero, the market condition will shift. For instance, ethylene will move. You have a feedstock event that happens. Suppliers' internal pricing teams are aware of it, usually in real time, but they're building their increased letters. Month two, the increased letter will arrive on your desk. It's that is effective next month. You have about 2 weeks to respond. Month two or three, the published index will confirm the move. Your data finally shows what happened, but the contract window has already pretty much closed. So you were negotiating at month two using month zero data. Your supplier, on the other hand, was negotiating with current information. So that gap is not really structural. It's not something you solve with better relationships either. It's something you solve with a better data infrastructure. So the key message really, Michael, is it's simple. Using delayed data is equivalent to negotiating with yesterday's information. And yesterday's information, I mean, in a moving market, it's not neutral. It's really a disadvantage. Um, so it's not about you know any tricks or anything. It's being informed and being informed on a timely basis rather than looking at data that's already old. Um, it's it is an issue with not just publications or indices, but with anything, with any type of negotiation. You really want to have the most current data at your fingertips, and you want to negotiate using that. So, you know, that takes us into leverage, which is basically the trust problem. You know, the second failure mode is the trust problem, or more specifically, the problem with trusting data that isn't built to serve buyers. The numbers on the slide here are illustrative, but they reflect something real and common. The published settlement at $1.42 per pound versus the actual transaction price of $1.27 per pound. So yeah, you have that uh, gap there, that 15-cent gap. That's not noise. It's not a rounding error either. That's a structural gap between between what's getting reported and what actually changes hands. Because why does that gap exist? It's because a lot of the data that buyers rely on is really supply reported, or a publication that's curating this data through conversations with market participants, many of whom have a large interest in where that reported number lands. So it's not a conspiracy, it's more of an incentive structure. I talked about it earlier. We've talked to procurement managers in the past who are genuinely confident in their data, they've done the work, they're following the right publications, and they have a process. And, and when we actually run the benchmark against what they're paying, that divergence is consistently larger than they expected. Not because they were careless, but because of the data that they were using. It just wasn't built for their side of the table. So again, I want
Certainly a more
to
common problem than most people would think, Brian, right?
exactly, exactly. So really, we already launched that poll. Um,
Yeah. Oh,
you
yeah.
know,
I know.
a,
I moved that poll around in our preparation, so appreciate you jumping through that, man. Um, I think I'll grab the ball here and kind of talk about the other two leverage failure modes. The third one here is one that I like to call grade blindness. It speaks to the lack of precision. And it's the one, for the custom injection molders out there, the folks that are buying a lot of different types of engineered materials or specialty grades. It's the one that can really be the most challenging. So I'm going to give you an example of what I'm talking about here. We've got high density polyethylene on the screen, which is about as commodity as it gets, generic blow molding grade. Um, Now we have a second grade. Let's look at the one in green here that is also high density polyethylene blow molding grade, but it has a compounded in UV stabilizer. It has an anti-scratch resistant, maybe it has a regulatory specification. And all of a sudden, we've got a 25 cent a pound or more delta between the two grades. And if you were to look at a commodity HDP index, your benchmark is going to be off before you even start the conversation with your vendor, which means you have an anchor, right? That's not in the right place, which can certainly be bad, right? And lead to bad outcomes. And one of the challenges in our industry is if we think about the polymer pyramid, meaning commodity resins and going up in terms of increasing performance and cost, this problem can compound itself on itself, I guess, pun intended there. Nylon six grades, right? If they've got glass fill, if they're for an automotive application, PCABS with flame retardants and maybe compounded in color and PTFE for lubricity. I mean, you get the picture. The spread between what an available index number is and a properly benchmarked specialty grade can be very substantial. The other challenge is as you move up that pyramid, there just really aren't as many options for an index. So it can be a really tough way to understand what you should be paying. And that wrong benchmark can create false confidence. It can lead to misaligned expectations and just an overall bad outcome. So the fourth one is one that even sophisticated procurement organizations, some of the ones that have been doing this for a long time, we still see, and it's not that in those cases that the data doesn't exist. I mean, they have the data. The problem is that it's not usable at the speed with which folks need to operationalize it within the world that we live in, especially today. You really need to have multiple subscriptions, not only on price, but on the other elements of supply, right? Supply chain, import, exports. I mean, you also need the industry relationships, and you need to be able at times to normalize across those different sources, different currencies, different units of measure. I mean, how many times have we run into the pound versus kg conversion challenge? And I could go on and on, but you need to be able to synthesize all that at a specific grade at a specific plant with a specific logistics tier. And you need to be able to kind of pull all that together in days because your one supplier gave you 2 weeks. Now, if you think about how that can manifest itself with what's in your inbox right now, if you're buying dozens or hundreds of grades and you're looking at hundreds of price increase letters, I mean, that requires a process that's staffed accordingly. I mean, in most procurement teams, they either don't have that capability on staff or it, they're asking that person to do way too much. So even when the good data theoretically exists either in the ether, even in the organization, the practical answer is it doesn't always get used at all, sometimes at all, and more often at the right times. Um, Brian, I don't know
Yeah,
if that
yeah.
resonates with you.
Just to jump in on that. So even when we're working with clean data, the normalization work, the currency conversion, like you said, the unit of measure alignment, grade matching across supplier naming conventions, that's not trivial. And when you're doing it on a deadline with the letter sitting on your desk, most organizations don't have the infrastructure to execute. So speed of insight matters as much as quality of insight matters as well.
Couldn't agree more, Brian. Did we have another poll here, or am I?
Yes, yes. So I'm actually about to launch another poll right now, which basically is going into the four failure modes that creates the most risk in your organization, whether it's timing, trust, precision, or access. So I'll put that poll right on the board here, and with that, I'll just drop it over to you, Michael.
Perfect. Thank you, Brian. Probably shouldn't have tried that, taking it off share mode. That's what I get for trying to be
Not a
Zoom
problem. But
Zoom
before we go,
savvy.
I do want to review what uh, this first poll. Again, the four choices were accept and pass through, push back verbally, request justification, and validate using independent data. Uh, Look, overwhelmingly, our poll at 69% of our participants here said requesting justification is what their first move is. Right after that is validating using independent data, and of course pushing back verbally and accepting and pass through the least picked choices on that. So yeah, requesting justification and validating using independent data. So I'll drop this second poll up, Michael, and toss it to you in the meantime.
Appreciate you, man. And yeah, just a quick thing to say there. Request justification. I know we're advocating for validating using independent data, so those folks get 5 stars. Requesting justification is probably second best, right? It speaks to the difference between the posture at the table. If we're able to enter the table with our own data and challenge the assumption right away, it kind of gets to that level one step earlier is really what we're trying to articulate there. So with that, thank you, Brian. So we talked about the four named failure modes. What we need to do now is talk about what does this workflow look like that prepared buyers have, and um, what does that look like from folks that are prepared versus folks that are doing this differently. So we've got 4 steps here on the screen: validate, quantify, identify, and respond. So the buyers that come to the table without the preparation, they just skip that validation step. They go straight from letter received to reaction, and the absence of that validation means that everything downstream is built on maybe things that are in the past, maybe guesswork, maybe nothing. The prepared buyers, they start with that question when they get that letter: is this claim supported by independent market data? Not, do I believe my supplier? Because that's a relationship question. It's, can I verify this against transaction grounded benchmarks? So that's where the data question enters and comes in, and that is an answerable question. So bringing trade publication data, supplier narratives, historical invoices, an index, you know, that's not necessarily enough. You need to have ones that are benchmarks that are based in transactions, that have the grade level precision, and ideally that have peer aligned comparisons. So when we talk about normalizing for volume, how are you doing based on, the size you are and the amount you're purchasing versus your peers. And then some confidence indicators, right? That last one's important. A benchmark without a stated confidence level is just a number in the range, right? You don't know if it's built on one data point, two, or 10,000. Reliable market intelligence is going to tell you how confident it is and why, and that's the transparency that allows you to use it as a negotiation anchor. And I mentioned the buyer side posture before. The market intelligence that you have should be structured to protect your position, not to or I should say, to challenge the supplier's narrative, not just to say, "Yep, that's right, check it off." If your data is built the same way, it's not going to bring anything new to the table and thereby change the outcome.
Yeah, that's a distinction that gets lost in a lot of procurement data conversations. You know, the question isn't just, is this data accurate? It's whose interest does this data serve? And those are different questions. Those are different questions to look at. So, you know, I want to jump into this. Of course, these are five questions that, just looking at it on the surface, yeah, if you're answering no to a majority of these, three or more, then yeah, your negotiation position is exposed to avoidable uh, risk costs there. So I'm going to read each one, and I want you to hold an honest answer for your organization, not um, aspirationally, but as it actually operates right now. So, number one, do you know what your highest resin spend grade should cost today? Not last month. So, do you know what the highest spend resin grade should cost today? Not last month. Um, and again, that's yes or no. Moving on to number two, can you determine whether a supplier price increase is justified before responding? Uh, Maybe you can, maybe you can't. Again, do you know the market conditions going into that? Um, the likely outcome of what the sentiment or what the data shows. Number three, do your benchmarks reflect your specific grade characteristics and not just base resin categories? We're talking about specific grades because yes, there's a lot of grades out there, especially when it comes to resin, So when you're talking off spec or Y spec versus something specific, whether it's a specific melt index, whether again is does it have a you know automotive versus uh, construction applications to it. It just depends. Again, it's a yes or no question there. Number three, do your benchmarks reflect? I'm sorry, now going to number four. Do you know when your pricing compares to similar buyers in your volume range? Basically, what is the competition doing? Do you know what the competition uh, is seeing in terms of pricing? What are they paying? Um, Number five, when market conditions shift, do you detect changes before your supplier communicates them? Again, it you either do or you don't know. And if you answer three or more of these questions as no, then yeah, your negotiation position is very much exposed there. So
I think just the thing to jump in there is just like it's okay, right? I mean, if we're answering this honestly, just like any diagnostic, right? It doesn't always come back what you want it to, but the important thing to know is that there's ways to go about addressing this, right? And
yeah, so these are pretty much already filled out. And so what you're looking at here is a pattern that we actually see most consistently across buyers that we work with. Questions one and three. Most organizations have some version of a yes. They have an invoice price. They have some market reference. They even have a process, even if it's a rough process that they're looking at. For questions two, four, and five, uh, that's where the exposure pretty much lives right there. Question two is directly relevant to why you're on this call today. The April nomination for polyethylene, say it arrives at 30 cents, which we all saw. Before you respond, not after, but before, could you determine how much of that is cost recovery and how much of that is margin expansion? So if the answer to that was no, you're already behind. You're responding to a claim you can't even evaluate, and the supplier knows it. When we look at question four is the peer gap. We track this across client portfolios. The spread between what buyers at similar volume ranges are actually paying versus the same grade is almost larger than anyone expects, almost always. Not index variance either, actual transaction data. So if you don't have visibility into that range, your benchmark is really a number with no context. And number five is the timing problem from failure one. Now, if the first signal that you get is that the market is moved, that the market moved is the supplier's letter, that's the first signal you're getting. Your negotiation starts in their frame, not yours. You're validating their read of the market rather than really just arriving with your own. Now, three no's is again the threshold of this that we're looking at. That if that's where you are and it's where most buyers are, what Michael's about to show you here is not a hypothetical. It's a description of what happened to the buyer on the left side of that fork last month. So with that,
Yeah,
I'll toss it to you, Mike.
yeah. Thanks, Brian. I think that self-diagnostic is again always so good to kind of work through with your procurement initiative and your organization in general. You should benchmark everything. So I want to talk about this. This is the same letter, two buyers with a pretty big outcome difference. So gonna anonymize the situation here, right? We're talking about an HDPE blow molding, consumer packaging. Let's just say it's 10 million pounds a year, buying through distribution, received an April nomination letter, 30 cents a pound, something like what we saw from Viridian Dynamics on the first slide. So I want to walk you through what happens at the fork, right? With what we're talking about today. The same letter landing on two different desks. The outcome can be very, very different. The unprepared buyer is on the left. So this buyer has an invoice price of 67 cents a pound, a trade publication, and a long-standing relationship with their vendor. It's not nothing, right? Those are real assets, and please don't hear me saying something different. Those are very important. But what they don't have is a benchmark. They don't have peer transaction data, and they don't have a way to evaluate what the 30 cents a pound actually represents to what the market is. And so their response is, hey, great, thanks for the heads up. We'll have our team update the POs. And the increase is accepted. The letter is filed in the organization, and the new price is 97 cents a pound. So on the right side, we have the difference between the prepared buyer and the unprepared. It's the same letter. The first thing that's done is to validate the claim on the right. And this is where it becomes important, right? The April price nomination is had momentum. The market was tight, the inventories have been drawing, the Iran situation was fresh, operating rates were elevated, and there was a market basis for some of the movement. But there's a difference between what cost recovery and margin expansion looks like. And that difference is what the cost model helps to reveal. And if we kind of dig through and dig deeper into that, the cost model really only supports a smaller portion of that increase. Let's say it's around 8 cents a pound. The remaining 22 cents would be lumped into the margin expansion and recovery activity. And there's the second thing that benchmarking exercise that client did reveal that their current price was 67 cents, as I mentioned. And that was already above the market, right? So that's where that benchmarking can come in. And so now they're being asked to accept a letter on top of a price that was already exposed versus what they should have been paying. So at that point, they've gone through that exercise and now they are able to respond in step three with data, not opinion. They have the relationship in this scenario, but they're not leaning on it to save the situation. And it's not, hey, we've been a good customer. It's, hey, the cost model supports this. And here's the benchmark and how we're relative to it. And, you know, we are going to, we're prepared to accept the market justified increase, right? This particular vendor went, or they went to qualify another distributor, same product, so they had leverage. And suffice to say, at the end of the day, they were able to only accept a portion of that increase. Which, if you do the math on the screen here, it can add up quickly. Now, I know what you're going to say, Michael. Well, there's no way in this example that they wouldn't have caught it. They would have fixed it next month. I'd challenge that and say in some cases I've seen them not catch it, but let's run with the assumption they do. Okay, you catch it the next month, but you ordered material in that month. So there's an amount of money that you overpaid. And if you're doing that as part of your strategy for every grade, every single month, that's where that compounding effect can really come in. And that's where the math can become really critical. So what I kind of wanted to just close that with is the data itself wasn't doing the negotiation. It was the buyer. It was you in the seat preparing. It was the preparation that did it, and the data was what really created the leverage. Brian, I know I stole your thunder a little bit about like the compounding effect here, but this is really important, right?
Yeah, yeah, exactly. So, um, let's we could put a financial framework um, around this here because we want to be concrete about why it matters at the business level, not just the procurement level here. So, um, looking at this, what we have here, this illustrative example. Look, you have 5 cents per pound unnoticed premium here. So you're looking at something that's 4 million pounds annually, and that's $200,000. And across multiple grades, that adds up quick, which is every real procurement program. These losses stack up and they're inevitable. And honestly, they're invisible as well until you add them up. Um, so, three ripple effects worth naming here. First one is going to be gross margin stability. Um, Resin cost moves faster than consumer pricing adjustments. So when you absorb an unjustified increase, the impact is immediate. Um, Consumer pricing relief, I mean, if it comes at all, it lags by a quarter or more. Secondly, cost forecasting accuracy. If you don't know where the market actually is, you can't model where it's going. Your financial planning is built on shaky foundations. And third, competitive positioning. If your competitor is paying 8 cents less on the same grade, that's not luck. That's a structural cost advantage that shows up in their pricing, in their margin, and their ability to compete for business that you want there. Um, so yeah, again, I mean, 4 grades here. When you have that unnoticed premium, you realize it when it comes out in the wash, especially when you're looking at your accounting there.
Absolutely. Yeah, Brian, I mean, thank you for walking through that. Small differences really do drive large financial outcomes with the compounding effect. And, let's I guess let's close now with what you should do practically. Three different actions. They're all executable words today. They're all things you can get done next week when you get back into the office on Monday. Action one, you take your top five highest spend resin grades. Everybody's got a Pareto rule, at least most companies that I've worked with. Not your whole portfolio. Start with the big few. These grades are going to have the biggest impact anyway, and validate your current pricing against independent benchmarks. not your suppliers, not a trade publication. ResinSmart is a way for you to do this. It's not the only way, but it is a way for you to benchmark yourselves against something that has transaction grounding, grade level specificity, and can allow you to understand what you should be paying for your size. And number three, enter negotiations, the next one that you have, with documented positioning on where the market is. So this creates a situation where it actually gives you confidence, and it's not attitude or ego, which some procurement professionals get accused of. It is confidence because the data is helping to create the leverage. Um, I would say I think we've been long-winded enough today, Brian, but the closing message just to leave everybody with is it's the outcomes that you get at the negotiation table are not purely related to how good your relationships are, how long you've been in this business, how hard you push back, how loud you scream. Some of those first few are important. Again, I'm not saying that they aren't influential, but at the end of the day, the most common activity that we've seen that leads to good outcomes versus not good outcomes at the negotiation table is preparation.
Mhm.
And that preparation requires information that's been validated. And that is what you need more than anything. So whether it's ResinSmart or whomever your trusted data partner is, make sure that you go down that road together. Um, we're going to do a quick Q&A. We've got plenty of time here. But before we do that, I want to make sure to be clear that we're offering everybody on this call a free ResinSmart benchmark for your top spends. So no commitment, no pitch call required unless you want one. You tell us the materials after we get an NDA, and we'll tell you what you should be paying. So I'll drop the link in the chat here. And if you're interested in starting a free trial of ResinSmart.ai, you can grab the link or reach out to me directly. Brian, before we go to Q&A, anything else that I missed or that you wanted to say?
No, just this. If you identified with any of the four failure modes today, look, that's a starting point. You don't need to solve all of it at once. It's just knowing your benchmark on your top spend grade is step one, and it's actionable this week. So with that, before we get into any Q&A, I do want to look at this poll here again. The four failure modes that we outlined there. Um, which one creates the most risk in your organization? Number one, timing. Number two, trust. Three, precision. Number four, access. So, and this was tight. This is really tight. I mean, it was number one was trust. That was the number one failure mode that our participants said created the most risk in their organization. And number two was a tie between timing and precision. And lastly, it was access. So that was very interesting, especially a lot more tighter in terms of the results compared to um, our first one there. So that's very telling, so to speak. So as far as questions, again, we do have time for questions in the webinar chat here. Feel free to post your questions there. We did have uh, some questions that were emailed here. Let me see. Here's one that came in. Number one, how should we kind of just answered this the whole thing? How should buyers respond when suppliers resist justification requests? So I'll start with you on that because again, Michael, that's very
Yeah.
it gets dicey, especially now. I mean,
Yep.
look, I mean, I'll say this past 2, 3 months, we've seen so many price letters across all of these grades. It was almost for a little while there, it was almost impossible to keep track of all of them. But I will say it's not so much of a seasonality thing, whether it's the peak summer driving season, hurricane season, you kind of can prep for something like that. You can kind of factor something like that in. But it's also when we get into major geopolitical events, which will hit home. I mean, obviously here um, in the U.S., where we're starting to see gas prices go up. So we already know consumer uh, pricing is moving up, not just on at the pump, but also that's something that's already being factored into um, other sectors as well, whether it's you know retail, construction, whether it's the restaurant industry. We get into packaging a lot. So when you get that supplier resistance to you basically uh, trying to justify data or something like that, yeah, it can be an issue. So number one, it's you know really just coming with as many key points that will give you that leverage. But Michael, you've been on that side
Man,
of
I
the
bet I bet, yeah, man. I mean, to that point, right? I mean, when I worked for Poly One, I mean, I was on the sales side, right? So it was something we talked about, right? What happens if the justification requests are asked for, and some folks, were given direction to kind of stonewall that. Um, my perception is that it's again back to trust. You you're almost better off as the buyer not fighting the resistance.
Mhm.
It's really, if the supplier is not willing to provide the justification, that's where the market intelligence and doing the homework with the right market intelligence partner can really help you, because then you bring the documented market position to the table with you. If you can bring a benchmark that's for somebody your size, that I mean, that completely changes the conversation. If you're able to do the homework on what goes into, what you're buying, if it's nylon 6, you're coming to the table with trusted caprolactam data and what's happening in the feedstock space all the way back to benzene. That changes the entire posture of the conversation. And at that point, if you're talking about those things and asking for those things and they're still not willing to share, hey, I mean, something's got to change. So.
Yeah. So kind of a follow-up to that is how quickly should buyers respond to price increase letters? So, you being in the industry and me being on the market intelligence side, usually I would get the price letter and I would have informed a lot of market participants that hadn't got it yet. Some that got from their specific supplier, and they weren't sure if it was just a one-time thing or if it was across the board. So, one of my jobs was to gather as many letters out there, and you could see the trend if everybody's pushing for 30 cents, 20 cents. You could see if this was a you know conglomerate, if this had momentum across the board, or you could tell if it was just one producer that needed to raise prices in a pinch. But you know, so that's the follow up I had on that is how quickly should you respond to this, and does it depend? I mean, does it depend on your situation and your account size, how big of a buyer you are?
Yeah, I think my answer to that would be it depends. I know it's kind of a safe answer, and I think we've been fairly bold with our statements on this call. So I'll say once, safer response. I think you don't want to let it go too long, right? Some of these do have a deadline, and some of them want to be implemented within 30 days. So, I think the earlier the better to respond, but not until you've had a chance to internalize the cost positions and work with the right partners, either within your organization or within your ecosystem of partners, to then go back and be able to take that first stance after you've had a chance to validate the market.
Mm. So here's
We,
a question that we have in the chat here. Uh,
yep.
no resin vendors share a cost breakdown to understand the part of the cost that is impacting the price due to uh, whether it's feedstock cost, freight cost. Is there a cost breakdown chart that RTI can suggest or propose? Um, so if I understand it correctly, when they're sending out a price increase, um, they're not giving a breakdown on why. I don't always see that. It really depends too. I mean, some letters can be vague. Some letters will say exactly what it is, whether it's the competitive environment or whether it's force majeure or something like that. That'll be some justification, but from a supplier standpoint, that'll be some justification. But um, this question it's correct. I mean, vendors don't really give you a breakdown. It's almost like it's the buyer's job, really, to come with justification and outline stacks of data as to why they shouldn't get a price increase. You never really get that from a vendor side of thing.
Yeah, I think this is a great question, Alfredo. I'll just kind of stack some things on top of that. Brian's right, right? You're never gonna get a, well, never is painting with too broad a brush. In general practice, the suppliers provide the least amount of specifics as possible to give them the most coverage to the things to point to, right? I mean, we all know that. Um, in certain cases, you can negotiate some visibility to the BOM or the bill of materials. We've seen that happen for some specific applications where the buyer was able to get leverage. And in those cases, they will give you a little bit more specificity on what's driving the increase. But to answer your question specifically, I'm sharing something here on the screen that we shared at the Flex Forum a couple of weeks ago. Um, when we go through a benchmarking exercise with a client, we're helping them understand, are we paying the right price for the material, right? And that stacks up, it goes to our proprietary cost models, and we help you understand what's the cost component, what's the margin component, the logistics component, the premiums that you would pay maybe for regulatory, and then how that compares to other folks in the industry. So we take that approach in the benchmarking process too. And so we try to help people apply that to the price increase, right? So the idea, we use polyethylene as the example today on the call. So the idea behind that would be, yeah, these big guys aren't going to tell you what's in the 30 cent a pound increase, but we're able to help you understand that this part of it, right, depending on what data you look at, 7 to 8 cents of that is ethylene costs, right? The rest of it is margin, right? So that's what we try to help our clients understand is what does that price increase mean and which part of it is which part of the costs. So hopefully that helps, Alfredo.
So I guess we have time for one more question that was in here. And
Yeah, let's
uh,
sneak one more in.
yeah, so last question. What happens when peer data is limited?
Yeah, I think I mean I can definitely take that one. When peer data is limited, obviously your leverage goes down, right? I mean that's maybe the most obvious statement in the world. From the way ResinSmart looks at this is, the lower the confidence score is when we apply the benchmark on the peer component, we're pretty transparent about that. It doesn't mean that the benchmark is not useful. It just means that maybe it's more driven by the cost up part of the analysis, which means you need to be, considerate of the range, right? There would be a range of pricing that you would be entering that negotiation, and you want to be a little bit more careful with what you use from an anchor. And so we would help you kind of think through that and, go assess where in the market maybe that we haven't looked that to get that. But getting the peer data can be the hardest part, and a lot of folks over the years have built their own internal networks that they lean on for that, which is great, right? Working with somebody that has visibility to more and more of those transactions, like a partner like ResinSmart, will give you a better chance of having that peer benchmark and thereby really unlocking the most value at the negotiation table. That's how I would answer that, Brian. I don't know if you have anything else you would add.
Just get out there and expand your network.
Right?
That's the best answer to that I can think of. Because yeah, if your data is limited and you're scrambling to find data, yeah, expand your network however you can. And that's a pretty general answer to that. So outside of that, that's all the questions we have. So, Mike, I will toss to you unless you have any final words. Again, uh, that free trial,
Oh
ResinSmart.ai.
yeah, let me drop that link in there. That's a good reminder. Sometimes I forget things. Let me see if this gets out to everybody.
There we are. Yep. So link is in the chat if you want to look at that free trial there.
Yeah,
So
and the link is going to be sent. Sorry, Brian. The last thing I will say is I'll send the link and some of the content that we walked through today to everybody via email. And if you're interested in talking about this more and how it relates to your business, we look forward to that conversation and hope everybody has a fantastic weekend and a great rest of your Friday. All right, take care. Thanks again.